So in this video I'm going to go through the solution to the question Cain Ltd, a deferred tax question. I won't be going through the full solution because there are aspects of it that I haven't yet covered in earlier videos. So in particular I won't be demonstrating anything to do with non-current assets in this video in the context of deferred tax. So we have the question, we've got our intangible assets, current liabilities, non-current liabilities, total net assets of 894,600. And as you can see, there is a number of notes attaching to many of these items. And of course, these notes are relevant in the context of preparing the deferred tax computation. So the objective of the question at this point is to identify the carrying value and the tax base value of each of these items in the balance sheet. I went through the concept of carrying value and tax base value in a previous video. Carrying value in general is very easy to determine. It's, with the exception of non-current assets, it's the values that are already stated in the balance sheet. So in my solution, I'll be able to put these values directly in as the carrying value for the relevant items. So I'm going to switch to my solution. And I've replicated the balance sheet all the way down to the end of non-current liabilities. So ignoring non-current assets, I can slot the carrying values in as stated in the question. So these, as I say, are quite straightforward. Okay, no particular demanding nature to these. So that's that, and as I say, I've omitted non-current assets. The tax base value then is a little bit more challenging, but once you establish the principles, calculating the tax base is not too difficult. It's just, as you say at the start, getting familiar with the principles of what tax base means in the context of the different assets and liabilities. So this slide just sets out the basis by which the tax base value of items is determined. It's one that I demonstrated on a previous video. So just to look at the key points again, the tax base value is obviously set out in the middle column here, and the nature of the items that these tax base rules apply to is described in the first column. So for items granted capital allowances, the tax base is the tax written down value. That covers most tangible fixed assets. You're familiar with this from doing capital allowance computations in case 1 add back questions, where I use the term tax base as one of the working notes, and tax written down value, of course, is something that we've seen both in income tax and corporate tax. So I'm not going to go into great detail on that point because I'm not yet covering tangible fixed assets. There are some additional considerations in respect of those. Items allowed on an accruals basis. Now, what does that term actually mean? If you think back to case 1 computations and corporate tax returns, certain adjustments that we made, particularly in the case 1 computation, entailed adding back an item because it was maybe an accrued value for pensions or for royalties or for something like that, and other items that were accrued didn't have to be added back. So if we don't add back a value in a case 1 computation because it is accrued, okay, so if we don't have to do that, that tells me that the item is allowed for tax purposes on an accruals basis. So think about that again. If you don't need to add back an accrued value in a tax computation, then that item is allowed for tax purposes on an accruals basis. And such items, the tax base is the carrying value. So examples of such items where we don't add back the accrued element would be things like staff wages, staff bonuses, directors' remuneration, rent rates, insurance. Most expenses would be allowed on an accruals basis. Loan interest, typically, if it's business loan interest, is allowed on an accruals basis. That is compared to items allowed on a cash basis. Now again, the way I suggest you think of these is if we add back an item in a case 1 computation and perhaps we get to deduct the amount paid in the tax return, then the item is allowed on a cash basis. Okay, so the classic examples of these: accrued pensions are added back in a case 1 computation. Royalties are fully added back in a case 1 computation, but the amount paid is deducted in the tax return. So again, just note that phrase, the amount paid is deducted. That tells me that the royalties are allowed on a cash basis or a payments basis. Such items, the tax base is 0. Okay, so cash basis, 0. Accruals basis matches carrying value. For permanent difference items, now these are items which are either expenses which are always added back and never deductible in any context for tax purposes. The examples indicated: penalties, entertainment expenses. These are permanent differences, so they cannot give rise to deferred tax, so the tax base must match the carrying value. Okay, there must be a 0 difference between tax base and carrying value. And the same principle applies if income is not taxable. So government grants received or Irish dividends, these are non-taxable items, and if they happen to be contained in your balance sheet, you must set their tax bases to match the carrying values. Other balance sheet items: inventory, debtors, creditors. Tax base is the carrying value. There is a small issue with provisions for bad debts, and we'll see that in the solution. So with the tax base rules now outlined, let's have a look at determining the tax base for the various items within the balance sheet. We'll start with the intangible assets. So that's €60,000 carrying value, and just need to look at note 2. So intangible assets consist entirely of unamortized development costs. So unamortized development costs. Remember, when you incur development expenditure, you're allowed a full tax relief on the amount spent in the period. So that's cash basis. You're allowed it on a cash basis. So the value for tax purposes of unamortized development costs will be 0. Okay, you're allowed the R&D expenditure on a cash basis. You get relief when it is paid. So the full amount is allowed on a cash basis. Closing stock, we saw already that is allowed, that is matching the carrying value. So we don't need to do anything on that. Trade debtors, there is a consideration here if there are provisions for bad debts. But in this particular question, trade debtors don't have any provisions for bad debts, so the 106,000 carrying value will match the tax base value. Prepaid expenses, there nearly always are working for these, so I might just highlight that term. This is a pretty standard item that needs to be figured out, because prepaid expenses obviously can consist of many different elements. So looking at the question, prepaid expenses, the total is 5,400, and note 3 gives us a breakdown. So they consist of the following amounts: light and heat, insurance premium, and Irish rental income receivable. Okay, so I'll just have a working done on my solution for this. So those are the values in the balance sheet. ABV is accounting book value. Now for light and heat, again I asked myself, if I was doing a case 1 computation, are they ever added back by virtue of being accrued? If they are, then they're allowed on a cash basis, and if they're not, they're allowed on an accruals basis. So you should hopefully be able to identify that light and heat is allowed on an accruals basis, and from the rules, if something is allowed on an accruals basis, its tax base matches the carrying value or the accounting book value. For insurance premium, €600 accounting book value. Again, if you think back to a case 1 computation, we don't add back accrued insurance. There's no need to add it back. So if it's not added back because it's accrued, that tells me it's allowed on an accruals basis. Okay, so again, exactly the same outcome. And for rental income, this is taxed on an accruals basis or strictly an income receivable basis. So it is exactly the same outcome. It's an accruals basis, so its tax base matches its carrying value. So in this particular question, both the accounting book value and the carrying value and the tax base value of prepaid expenses match each other. So 5,400 goes into my tax base value. Cash at bank doesn't give rise to a deferred tax issue. It's in the same category as inventory, debtors, creditors, and indeed creditors will match the carrying value. So accrued expenses, again a very standard working item. So let's look at the question to see the breakdown of the 7,100. Okay, so accrued expenses consist of wages due, loan interest, and a pension premium. And the loan interest qualifies as protected interest, so probably worth highlighting that term there, protected interest. So again, wages due. If you ask yourself, do I ever need to add back staff wages? The answer should be, no, I don't. They're fully allowed on an accruals basis. So that 3,400 wages due, its tax base is going to be allowed using accruals, so its tax base will match. Again, the rule says that if it's allowed on an accruals basis, tax base matches the carrying value. For the loan interest is protected interest. Now this is a non-trade charge, and hopefully you can figure your way through this. Charges generally, whether they're trade or non-trade, are allowed to be deducted on the basis of the amount paid. So if you think back to a case 1 computation, we add the full charge amount that's in the income statement back to the accounting profit to arrive at case 1, and then in the tax return we deduct the amount paid. Now there's the key insight. The amount paid is deducted. So these are allowed on a payments basis or a cash basis, and on that basis then because they're allowed on a cash basis, the tax base value will be 0. For pensions, it's much the same point. We add back accrued pensions in a case 1 computation, so we only get to subtract the amount actually paid. So exactly the same outcome. Pensions are allowed on a cash basis, so the tax base is 0. So my tax base of these items is 3,400. Okay, so 3,400 gets slotted into my solution here. Taxation due doesn't give rise to a deferred tax issue, nor do loans, bank loans. Provisions for liabilities, you need to just check what the story with these is. You've got provisions for warranty costs, 24,000, and provision for deferred tax, 11,000. Now, the important point here is that warranty costs are allowed for tax purposes on a cash basis. So when you actually spend money making good a warranty, you get the tax deduction. So if they're allowed on a cash basis, again, cash basis tells me that the tax base value must be 0. So I can slot these in. Deferred tax in and of itself doesn't give rise to deferred tax. So cash base is 0 for the warranties. So the total tax base is 11,000 for the provisions. So 11,000 for provisions. And the loans again don't give rise to deferred tax. So other than the non-current assets, we've identified the tax base value for all the various items in the balance sheet. And what you want to do is spend some time trying to understand the principles that were outlined. There are a few things that we haven't seen. We haven't seen leases in the balance sheet. We haven't seen trademarks and brand names. So there are a few other options that we haven't seen. And indeed, loss relief is another issue which we'll see in later questions. So while we're not there yet, we're getting there.